How much of a risk do you put on the economy falling into recession in, say, the next 12 months?
Well, as I think as your show has highlighted, credit is being really crushed here. You know, over the last 6 months, credit is down sharply here. This has been a precursor of problems before. Look at 2007, 2008, when credit started being crushed here. This kind of portended the whole 2007 to 2009 recession. You know, I would say, however, this has been a flawed indicator that it's given many false signals here. I think when you start to go and look at the fundamental case for recession, you'd have to say it's a little bit questionable. Usually, as you slide into recession, you have speculation on the rise. You have the price of credit going up. You have the availability of credit going down. You have inflation tightening, and probably you also have some sort of macro shock. So some combination of that gives you a recession. Those aren't in place now, and so we think that the risk of recession near term is probably pretty low.
Yeah, but, you know, it's funny because our audience that are not professional traders or investors, right, Stan? I mean, they see their house price going up. Maybe they got a better job. The stock market, until recently, has done pretty well. Credit is one of these things that unless you've got a Bloomberg terminal or some, you know, high-dollar computer software, you don't really know what's happening. And so tell us what's going on there that might later infect the stuff that we do see every day.
Well, when you look at credit, which is either junk bonds or low-grade investment-grade bonds, those yields are going up relative to treasuries. So the credit spread is definitely widened here. Now, historically, when that tends to widen here, ultimately issuance will tend to slow. As talked about earlier, issuance has been very strong in the first half of this year, but it's now starting to slow. If issuance starts to slow here, then you're going to see less stock buybacks, you're going to see less capital expenditures, and that will ultimately slow overall growth. So that's the concern here. Is this a false signal like we saw in 2011, or is this a real signal like we saw in 2007?
When will we know, Stan?
Well, I think you're going to have to look at other indicators. You're going to have to look at index-linked indicators. You're going to have to look at inflation, CPI that comes out. You're going to have to look at job growth that you'll get tomorrow here. If job growth is solid, if inflation remains low, then it's unlikely you're going to have any sort of near-term recession.
All right. Stan Shipley, Evercore ISI. Stan, thank you. We appreciate it.